Investing in single stocks as a smart investment or a risky gamble is our discussion today in this video. Investing in individual stocks can offer a big chance to make more money from your investment. Sometimes, putting a small amount of money into just one company's stock can make you very rich. But like any way you put your money into things to make more money, there are good things and not so good things to think about. If you decide to try this, the good result could change your life. Look at the positive and negative sides of investing in individual stocks. Keep watching until the end to find out how you can experience the amazing potential of stocks that grow and stay steady over a long time. The most exciting thing about putting your money into individual stocks is the chance to make a lot more money. In the past, some stocks have grown super fast, and people who bought them early made a lot of money. Even companies that have been around a while can give people who invest money in them more money than they would get from other places. People who could see that these companies would grow bought their stocks before they started growing, and some of them ended up with a ton of money. For example, people who invested in big tech companies like Amazon, Apple, and Google when they were just starting out have seen their investments grow quickly, much more than the whole stock market. Imagine if someone had put $5,000 into Apple stock back in the year 2000. By June 2023, they would have made more than $2 million. This isn't something that happens all the time, but it's possible to make great returns by investing in smaller companies, or ones that aren't as famous as the biggest ones. The possibility of making a lot more money than usual is a big reason why some people want to do this kind of investing. When people invest their money in a way where they're not doing much, it's called passive investing. They let experts handle their money. But if you buy individual stocks, you get to decide where your money goes. Being really involved means doing a lot of research, looking at financial statements, checking how the company is doing, and staying updated on what's happening in the market. This hands-on approach lets you make choices based on what you think after looking at everything. Being so involved can make you feel like you're part of things, and that you must take responsibility because you care about the companies you're invested in. If you like the challenge and excitement of picking stocks, being really involved can be something you enjoy about investing in individual stocks. When you buy one company's stocks, it can feel like you're connected to them in a special way. It's different from putting your money into funds and other investment things that don't feel personal. Owning stocks from certain companies can make you proud and loyal. It might even feel like you're part of something bigger. You might really like the companies you invest in, especially if you like their brand, what they make, or the people leading the company. For some, this connection might come from respecting the company's values, mission, or how they help society. This strong connection can make you care about the company's success beyond just making money. Because you care so much, you might plan to stay invested for a long time and not worry too much if the stock prices go up and down quickly. This can make you feel like your investment has a purpose and make the process of investing more fun and satisfying. However, investing in individual stocks has some problems. These stocks can be affected a lot by what happens to just one company, the stock market going up and down suddenly, and unexpected things. Even a little piece of good or bad news can make the stock price change a lot. And sometimes the reasons for this aren't fair, because people are reacting with their feelings, not just thinking. The future of one company can depend a lot on how well they're doing financially, how much competition they have, who's leading the company, and what's happening in the industry and the economy. Because of all these things, the stock price can change a lot, and sometimes people can even lose all the money they put in. Smaller companies and ones in new industries are even more at risk because they're not as stable and don't have as much money as bigger, older companies. But even the big companies that have been around for a while can have things happen that totally change what will happen to them in the future. Look at companies like JCPenney, Blockbuster, and Toys R Us in the past. Unlike investing in mixed funds that have different kinds of stock from many industries, individual stocks put an investor's money into just a few companies. This can be risky because if these companies don't do well or their stock prices go down, the whole amount of money an investor has can go down a lot. Imagine if half of an investor's money is in just one company's stock. What if the stock price goes down by half, or the company goes out of business? Diversification is a way to lower risk and protect against one investment going bad. It means having different investments. Choosing stocks that do well takes a lot of looking and thinking. Investors need to spend a lot of time checking companies and seeing which ones might do well. Doing this requires a lot of time and knowledge. If someone doesn't have much time or experience, it can be hard to do this well all the time. And the investing world keeps changing, so investors need to learn and change their ways as well. Investing in single stocks means things can change a lot, like going on a wild ride. Stock prices can go up and down a lot every day because of things like how the company is doing, how the economy is, what's happening in the world, and how people feel about investing. This can make the price of a stock go up or down a lot, even if there's no clear reason. While this can be a chance to make money quickly, it can also mean losing a lot. Investors need to be ready for the happy and not so happy times that come with this kind of investing. The key to dealing with this is to think about long-term goals and not make quick choices based on what's happening right now. Remember that things change a lot in the stock market, and good investors learn to deal with it. Investing in single stocks can make people make choices based on feelings. They feel like they want to keep stocks that are doing badly or sell stocks that are doing well because they're scared. This can make it hard to make money from investing. To make good choices, people need to control their feelings and think clearly. They need to know about these feelings and have ways to manage them. Planning, setting clear goals, and looking at the investment mix now and then can help stop feelings from hurting their choices. Investing in single stocks can make people feel a lot of stress. The price of stocks can change a lot every day, and not knowing what will happen, thinking about losing money, and wanting to make good choices can make people anxious and not sleep well. Investors might feel like they need to make smart choices fast and worry about missing out on making money. They also need to know always what's happening in the market and with companies, which can be tiring, especially if they don't have much time or resources. Stress can make people make bad choices and feel sorry later, especially for people with not a lot of time or money. Stress can make it hard to think clearly, and this might lead to mistakes when making choices. A good way to invest might be putting 80% of your money in ETFs and 20% in single stocks. With 80%, you can get money when the whole market goes up. With 20%, you can choose companies you like and think will grow a lot. Putting ETFs and single stocks together can help you be careful and try to make more money. Some people have made a lot of money and done better than the market in some times, but doing this all the time is hard. To do better than the market, you need to know a lot about money stuff and make choices at the right time. Even professionals who know a lot have trouble doing better than the market all the time. For people with not much time, money, and knowledge, doing better than the market is even harder. While some people can do it, most people should try to make a mix of investments that fits their goals and how much risk they can handle.